So we're still focusing on the markets, talking about recent release of the headline inflation for the month of January by the National Bureau of Statistics, which showed a 0.17% year-on-year increase to 18.72%. So we've talked about the food aspect of it, talked about how the food inflation and what really were the primary drivers and what we should be doing, Nigeria should be doing as we go countdown to the next inflation numbers, as well as how the core inflation is also affecting businesses. So talking on the program with me right now is Doyinsola Afolabi. She's an investment analyst with AfriInvest. We're taking a look at how this inflation numbers affects not just the economy, but the markets as well. Doyin, good morning, and thank you for joining me on the program.
Good morning, Ari.
It's great to have you on the program. So taking a look at those numbers, I remember that having this conversation earlier with analysts from AfriInvest, there was a projection that the inflation numbers would increase, but not by this, much as we've seen coming in from January. Talk to us how this might affect businesses.
Looking at the headline inflation year on year to 18.72, which means the increased 17 basis points. What majorly contributed to this increase was the food index, right? We saw an increase across the food groups, bread, cereal, and then, yam, oil and fats, meat, fish. But looking at bread and cereal, there was these items were exchange rate sensitive. The issues we have with foreign exchange, the disequilibrium in the market, and then what we saw was a pass-through effect to the bread and cereal. But then looking at the other side, looking at the other items, the yam tubers, we saw an increase in demand for diesel, which affects the transportation of the yam, oil and fat, also, logistic issues also passed on. So this further increased the price of these food items and then increased headline inflation. So that's why we saw an increase. But then we saw, for core index, it's declined, right, because of the stability in energy prices, as well as the month-on-month.
Okay, so talk to us a little bit about the impact on businesses.
Yes, so how it impacts business in the sense that looking from the banks, this automatically means higher interest rates. They will give higher interest rates just to compensate for the high inflation risk, right? If they can put their funds in Treasury Bills, which is risk-free at 18.5%, therefore they'll be willing to take higher interest rates for risky, assets such as the loans. And then looking at the manufacturing sector, this is a high cost of borrowing to affect their business, high cost of production. If the manufacturers decide to pick up the bills for high cost of production, this will reduce their revenues, right? Then at the same time, they can pass it on to the consumers.
Which is what happens all the time.
All the time, right? They pass it on to consumers. This will negatively affect business.
But then in terms of consumer spending, you're talking about the manufacturers passing on the costs, and conversations with some other analysts is like you have consumers fighting back because they really don't have that much money in their pockets anyway. Yeah. How would you think this will also affect disposable income, for instance?
Disposable income will be pressured, right? Lower purchasing power for the consumers. Inflation means, high inflation means, high price, general increase in price level of goods. So spending more and getting less. They're getting less value for what they're spending, right? So what we also looked at was the statistics from the something you call the misery index. Yeah. Right, which is the inflation and unemployment. And you can see from statistics from the NBS that this index has increased from 51.2 to 52.3, which means that consumers are getting more miserable. You have more miserable Nigerians. Unemployment is rising fast. Even companies are laying off their staff. So in the meantime, as far as inflation continues to increase, you continue to see pressure on disposable income.
So talking about seeing that much pressure, you mentioned at this time most consumers will be finding it difficult to get good already before now, get good interest rates from their banks, for instance. And you talked about going into the Treasury bills. But what do you think about this recent move by FGN, by the federal government, to float a savings bond? Now, if you can't get into the Treasury bills, for instance, would that be another option to take?
Yes, yes. Treasury bills, if you can't get that, that would be another option for the savings bond. It's that what they've tried to do is it's sort of some financial inclusion. So for the bonds that you have that we've had, like a single individual, the difference is a single individual can come up at the auction and then suck up the 100 billion, right? Mm-hmm. But then for this allows every investor with as little as 5,000 naira to subscribe a maximum of 50 million naira, which is good, right? It's another option apart from Treasury bills. So if you can get Treasury bills, you can.
So inflation might not likely affect any of the yields on either the Treasury bills or bonds.
Well, before now, when investors want to price, their bonds, they factor in inflation expectation. All right, and from February, we forecast that there will be a moderation in inflation. So this must have been factored into bond pricing, right? Which means that we don't see a likely increase in interest in yields environment for bonds.
What about in the equities? Because you have most of these companies anyways listed on the Nigerian Stock Exchange. You have the FMCGs, that's under the Consumer Goods Index, and as well as the industrials.
If you look at the recent trend, you see that most investors have actually moved from the equities market to the fixed income market, right? Because in the past you've seen foreign investors were the major drivers of the equities market, and now they've exited because of the FX issues and the issues of repatriating their funds back. But then, if the FX issues are not resolved, we'll still see most focus on the fixed income market. And at the same time, we should not forget that the economy is in recession. It means that the fundamentals of companies are still challenged, companies on the stock exchange. So there's no major driver to improve investor sentiments in the equities market for now.
But then AfriInvest seems to be going out on a limb and is projecting a 16.9% inflation rate for February. But you just mentioned that and reminded us again that Nigeria is in a recession, and we still have challenges with regards consumer spending and investment, either from direct domestic or foreign direct investment.
Yes, correct. If you look at last year, February 2016, that was when we had the hike in inflation from 9.6 to 11.4 because of the increase in energy tariffs. So what we'll start to see from February is the high base year effect, right? It will start to kick in from February 2017 compared to February 2016. The high base effect will start to kick in. There we'll see a reversal in the inflationary trend, and then it starts to moderate.
But then you also have to realize that February this time last year, we were not in a recession. Nigeria was not in a recession. Yeah. Nigerians did not have to deal with what we're dealing with at the moment. So what would change? What new dynamics will they have to deal with?
Okay. I think that they're more like getting a hold of the whole environment, the FX issues. They're beginning to adjust. Right? So we don't see a devaluation. We expect a devaluation, but not in the near term pretty soon. But we don't see like a major hike in energy prices for now, things that will drive the inflation higher. What we expect is still a moderation, no major driver. And then, last year, December, when we had food prices still increasing because we had the festive season in that period. So from now till the end of the first quarter, we don't see any major.
All right, Doyinsola Afolabi, thank you so much for joining us on the program and sharing your thoughts with us. Doyinsola Afolabi is an investment analyst with AfriInvest.